After entering the adjusting entries and preparing the financial statements, the last phase of the accounting cycle involves closing the books. In the closing process, we will zero out the temporary account balances before we move on to the next fiscal year. The temporary accounts are revenues, expenses, and drawing. All of these accounts will go to zero during the closing process. The permanent account balances, which are assets, liabilities, and capital, will just transfer over to the next fiscal year. Let's take a look at problem 4-2 on page 204. Along with helping us with adjusting entries and financial statements, the worksheet also helps us to complete our closing entries. There are 4 closing entries, and one way to remember those is by remembering REND, REND. The first entry closes the revenue account to income summary. The second entry closes the expense account to income summary. The third entry closes the net income, which is found in the income summary account at this point, to capital. And the fourth entry closes the drawing to capital. So let's take a look at our problem. We're given a partial worksheet in problem 5-2. So the first place we need to go is the income statement column. This is where most of your closing information is going to come from, because you know the income statement has the temporary accounts here. So the first entry, keep in mind, is to close the revenue account. So if we come down, we will see our revenue account here, service revenue, with a credit balance of $60,000. If we want to zero out that account, we need to debit service revenue for $60,000. So we'll come over to our Excel spreadsheet. Now in the account title section on the first line, we need to enter closing entries to let the reader know what's about to follow. Okay, so service revenue was the name of our revenue account, and we need to debit that for $60,000. Okay, and then our offsetting credit is to the income summary account. Now, income summary is only used just to help us to close out our temporary accounts. Okay, and it'll get the same amount as the service revenue. So now we've actually closed the revenue account. Okay, let's take a look at our worksheet once again. The next entry is to close the expense accounts. So if we look at our worksheet, we've got several expense accounts, and each one of those has to be closed individually. Okay, they all have debit balances because they are expense accounts, so that's the normal balance. So to close them, we need to credit all these accounts. Okay, so the next entry is quite the long one, and let's don't forget to put our the date of the closing entries there. Okay, it's always done at the end of the period. Okay, first of all, I'm going to put in my income summary offsetting account because that's my debit. You know, all the expense accounts will be credited, so I'm going to go ahead and put income summary as my debit, but I'm going to wait to fill in the amount until I get all the accounts and amounts listed here. Okay, the first account on the worksheet was salaries expense. It had a debit balance for $19,000, so I'm going to credit that account for $19,000. The next one was rent expense. It had a debit balance of $6,000, so I'm crediting it for $6,000. Then we had depreciation expense, and that was for the office equipment. It had a debit of $1,000, so I'm crediting it to close it. And then we had depreciation expense, delivery equipment. it had a debit of $1,200, so we're going to credit that for $1,200. Office supplies expense was the next account. It had a debit of $300, so we're crediting it for $300. Delivery supplies expense was the next account. It had a balance of $430. Utilities expense had a balance of $900. And then miscellaneous expense had a balance of $330. Okay, so you know debits and credits have to equal when you're journalizing. So if I add up all these credits, my total will be $29,160. Okay, so in this second entry, we have closed all of our expense accounts. Okay, and notice that the total, the $29,160, is the total here, so I know that my math is correct. The third entry is to close the net income, which is in the income summary account, to capital. Okay, so what we're doing is we're just taking all the revenues and expenses and putting them into the capital account. Okay, so the way we do that, let's get our date in. Okay, at this point, our income summary account contains the net income from the business. Revenues minus expenses is your net income, and you can also see that over here on your worksheet. Your net income is $30,840. So I'm going to simply transfer income summary with a debit, since it's a net income of $30,840, into the capital account. So that's Dave Garlington Capital for $30,840. So now our income summary account is closed, and all the balances from revenues and expenses have been transferred over into the capital account. All right, we have one last entry, and that's to close the drawing account. So we're going to have to jump over to the balance sheet and pick up the drawing balance. Drawing has a debit balance, so to close that, we're going to credit it. So on the 31st, we're going to debit Dave Garlington Capital for the amount of the drawing, which was $15,000, and then we're going to credit not Dave Garlington Capital, Dave Garlington Drawing for $15,000. Okay, so all our temporary accounts are now closed. So R-E-N-D, close revenues, close expenses, close the net income found in income summary to capital, and then close the drawing to the capital account. So now our capital is all up to date, because our beginning capital balance, if we look over at our worksheet, was $2,320. Okay, so we'll enter that here. Then we added, with this entry, we credited capital, so we added to it the net income of $30,840. Then we subtracted the drawing. You know, to decrease capital, you debit it. So we have decreased capital by $15,000. So our new capital balance is $18,160. So after the closing process, The revenues, expenses, and drawing account will be 0, and the capital account will be updated with the new capital balance.